Thank you. Welcome, everyone. I'm glad to be giving you guys a presentation about cryptocurrencies. My presentation is going to be about 25 minutes, and I'm going to cover a few topics. Foremost, I really want to talk about what is the secular force driving this future in digital assets, because we're quite bullish on it. The second is I'll spend a few minutes talking about the bear market we're in and why I think it's a mistake for investors and holders and those interested in working on projects to really give up here when crypto is already down 70% or more.
Thank you for coming.
And the third topic is thinking about what it really means to identify winners and losers in crypto and introduce this idea that there is a crypto fang coming together. And I think we've already picked one or two platforms that could actually be this sort of crypto fang. So before I pull up my presentation, I want to give you a little background on myself, because I think there's a lot of folks who may think of me as someone who speaks about markets or about crypto. And I've been covering or doing research since 1993. So prior to founding Fundstrat 4 years ago, I was the chief equity strategist for JP Morgan, and that's a firm I had been at since 1999. But even before that, I was a tech analyst. I covered wireless and service providers starting in '93, right after I graduated from Wharton. And I started working at a firm called Kidder Peabody. Now, in 1993, wireless was actually a brand new technology. Okay, there were only 34 million cellular customers in 1993. There's 4.5 billion today, so it's been more than 100x. But in 1993, I was covering wireless because it was considered a somewhat marginally important sector. In fact, my counterpart at Fidelity, for instance, was the same guy that covered trucking stocks and retailers, and typically he was right out of college. And the reason people didn't think much of wireless, I mean, it's obvious today that wireless is huge, but the reason people didn't think of much of it back then was the average money manager was in his 40s, and to him, cellular phones looked like an expensive toy. In fact, they were called yuppie toys. The criticism was, look, cell phones are expensive, they're staticky, they don't do much. In fact, all you could do was place calls. But more importantly, they thought cellular phones were essentially going to become free, because in their minds, the most important business was telecom. Everybody wanted to be a long-distance company or a local exchange company or enterprise, and cellular was actually a way to defend those businesses. Me being 20 years old and covering wireless, and I was very fortunate to actually be given a sector so young, I saw it as a huge quantum leap in utility, and I think that gave me a big advantage. In fact, during the more than 14 years covering wireless, I was ranked number 1, 2, or 3 by Institutional Investor every year. So I feel very fortunate to have been given a sector at that time. But it really sets us up, I think, to understand what's happening with crypto. Because to me, wireless and the internet in the 90s was very much a generational change that people 20 years older than me simply just didn't understand. And I think that's the same thing that's happening with digital assets and blockchain today. And this is a chart showing Bitcoin dominance. What it represents is Bitcoin's share of market cap. And if you squint, you can see it started the year at 36%. And it's risen. Actually, at the time I sent this to Chain Exchange, it was 49, but now it's around 53%. Now, this is something that we actually predicted at the start of the year. One of our forecasts for 2018 was Bitcoin dominance would actually rise this year. But the reason it's rising is a couple of reasons. One is we have a bear market in crypto, and you've all witnessed it. So whether you're holding Bitcoin and you're down 68% or so, or holding some of these alts that are down even more. But the question you have to ask yourselves is, now that crypto is down here, is it appropriate to be bullish or bearish? And I want to just absolutely point out, it is a mistake to be bearish when you're already down. This is like looking at stocks in December 2008 and deciding that you wanted to become secularly bearish even though the bear market was ending. So I think the bear market has largely run its course in crypto, and it's been healthy, right? It's been resetting capital, It's resetting investor expectations. But most importantly, the only time you can really make money in a big way is to buy when investors aren't buying. That's the real opportunity. And I just want to jump to the next chart to highlight this. This is slide number 9 for those who are following. And this is showing you that crypto's returns, or Bitcoin's returns in any year, just come from 10 days. So in other words, if you don't own Bitcoin and you miss out on the 10 best days in Bitcoin in any year, you've actually been down 25% a year on average. On the other hand, the top 10 days for Bitcoin in any year average 500%. So again, I think it makes sense to just be a hodler and patient. But I think in some ways, I think the fact that Bitcoin dominance is rising is really proving that Bitcoin is probably the first fang of the millennial crypto fang. So let me sort of jump into a discussion about why I think crypto has a long tail and why we're talking about a multi-decade gain. And the first thing to point out is I think this is coming from the fact that banks today are really becoming the epitome of over-centralization, or they become too powerful. Let's start with a look at trust. This is from the Pew Research Center, and this is a measure of U.S. citizens and their trust of governments. And as you can see, trust is at a 60-year low in the U.S. Never has trust been lower. But it's not just the U.S. Across the x-axis is the growth rate of various economies, and the y-axis is the level of trust, and that red line represents the U.S. As you can see, trust across all countries is actually quite low. And in fact, the countries that are below this line, such as Argentina, Greece, Brazil, Poland, these are the countries, Australia, these are the countries where crypto is actually prospering, because it is about lack of trust of governments. But what about banks? Well, the top 5 banks in the U.S. control half of all assets, but that's not just the U.S. If you look at Finland, Norway, New Zealand, South Africa, the top 3 banks typically control 3/4 of assets. In other words, the banking industry is massively, massively powerful. And yet they don't treat their customers well. This is a survey from creditcards.com, and it shows that if an American has some fraudulent activity in their bank account, okay, normally, if this happened with Amazon, Amazon would apologize to you. Well, 60% of the time, an American has to borrow money from somebody if they've had fraudulent activity in their bank account. So banks don't treat their customers well. And in fact, their share of global profits is rising. This is a measure of the banking industry's share of global GDP. It's called value added from the OECD. And from 1970 to now, it's actually doubled. So think about it. In 45 years, when technology has proliferated, markets have proliferated, in theory, the cost of capital should be falling. Banks' share of profits globally is actually doubling. And that's despite, as you can see on the left side, a secular decline in interest rates. Imagine how much money banks are going to make when rates start rising. So clearly banks are overly centralized and making too much money, and it's really an industry that's ripe for disruption by technology. And again, it's clear, today many technology companies treat banks as customers because banks are big buyers of tech, but it's just a matter of time before the banking industry actually sees competition from technology. And that's because more and more growth globally is native digital. And we estimate this is hard to see, that it's about a $5 trillion opportunity. So if you had to say, what is the addressable market today for native digital asset and digital asset currencies, it's about a $5 trillion a year market. Okay, but what's going to power this? I think the big story is that it's about millennials. And it's not just about American millennials, it's really about global millennials. But let's put this in perspective. I've listed here every generation from 1900. So the first is the greatest generation. Those are the ones who fought World War II. The silent generation, those are the children of the Great Depression. The baby boomers, Gen X, and then I highlighted in gray the millennials. The millennials are the single largest generation ever in the United States. There's about 20 million more millennials than boomers. and 30 million more millennials than Gen X. So it is larger than the 2 generations that have preceded it. But what's interesting, before I talk about millennials, is I have a blue box on the right, and I listed the year that each generation peaked. But take a listen to these years: 1930, 1974, 1999, and 2018. The first 3 represent, within 1 year, major turning points in the stock market, right? In 29, we had the crash. 73 was the second major top in markets. That's 1 year before that generation peaked. And of course, we have 1999, which is the year this S&P peaked in the internet bubble. Oddly, I think that generations have actually also defined market tops. But let's think about millennials. Millennials, number one, just do not trust banks. This is a Facebook survey. 92% of millennials don't trust banks. Let's say you don't believe the Facebook survey. This is a survey from First Data. 71% of millennials would rather go to the dentist than go to a bank. And 33% believe banks won't exist in 5 years. Clearly, millennials hate banks. Why do they hate banks? They hate banks because their parents lost their homes in the financial crisis. And today, as you can see, generations are increasingly digital. Today, 70% of Gen X and 68% of millennials never visit a bank branch. They do all of their transactions online. So to them, native digital is something they're very comfortable with. But their economic power is something I think most people don't understand. Today, I've listed the share of income owned by each generation as a time series. The dark blue area is millennials. And as you can see, that number is rapidly rising from today, and the crossover is 2029. Within 10 years, millennials are going to control the majority of the wallet in the United States. So think about it this way. If you had to think about where money incrementally is being spent and who controls it, it's the millennial. I'm going to skip a few slides here, but I want to highlight some data from Chase. Now, Chase is a company I used to work for, and this is showing you that when you look at credit card spending by generation, okay, the red are silent generation and greatest generation. The blue, light blue is the boomers. The gray is Gen X. Those generations actually have declining credit card spending. The only generation consistently increasing credit card spend today are millennials. So in other words, anything happening in the financial markets is really going to be about what millennials do. And in fact, if you want to see this again in numbers, from First Data, their estimate is that by 2020, millennials will control about $7 trillion of financial assets, of which very small percentage is allocated to digital assets. But here's just a thought. What if 10% of that goes into native digital assets, into crypto? As you all know, the multiplier for crypto, estimated by Carl Simoni at Multicoin Capital, is about 20 to 25 times, which implies almost a $14 trillion increase in the market cap of the crypto space just from US millennials allocating into crypto. Now again, to appreciate how generations transform markets, think about the gold market. This is, the top chart shows you the price of gold. The bottom chart is the silent generation, okay, the number of people in the silent generation, and I've lined it up. The only time gold ever increased by 15x within a 10-year period was from 1971 to 1979. Now that did coincide with the US going off the gold standard, but it was also the first time the silent generation had access to gold. And again, it peaked with the silent generation. No other generation has expressed the same interest in owning gold. Remember, silent generation were kids of the Great Depression. Their parents lost all their money in the stock market, so they loved gold. But it's not just a US story. 43% of adults today are in the millennial cohort, as I highlight here. So now this is not unusual. 44% of the world's population generally is in this age group. But unlike prior generations, there's a very big difference in longevity. Millennials are expected to live more than 10 years longer than the equivalent boomer from this point going forward because of better health. So the impact of this generation is much greater. And so I want you to just think about the broad numbers. Today, there's about 50 million crypto wallets. And let's say that 20% of millennials get a crypto wallet globally. That's 500 million crypto wallets. That's a 10x increase in the number of users of crypto. And I think that's conservative. 20% is low, because that means there's still going to be more Twitter users by then than crypto wallets. But because of the network value, that's almost a 100x increase in the crypto market valuation. So again, penetration of just the millennial generation is going to drive a lot of demand. Now, I'm going to skip this really quick, but by the way, most of these millennials are in Asia. Almost 1 billion are in India and China. So this is very much an Asian phenomena as well. So now I want to just jump ahead and talk about Wall Street, why Wall Street cares. Now, I think probably the biggest proof of Wall Street cares is the announcement that came last week, which is that ICE is introducing something called BACT, which is a cryptocurrency exchange. Now, we've written about it. I don't want to spend too much time on here, but this is a big deal because this is essentially creating a physically delivered spot market for Bitcoin. But think about this quote from the CEO. He says, millennials don't trust financial institutions. To gain their trust, banks and brokers and asset managers can use a currency that millennials believe in, like Bitcoin. Using digital currencies bring a lot of sizzle. I mean, this is a capitulation. This is proof that Wall Street is going to start to spend a lot of time and provide that infrastructure to really help crypto become mainstream. Why does Wall Street care? Well, I'm just going to fly through these really quick. Binance makes $1 billion a year. But it's not just Binance. Bitmain's making $1 billion a year. So you already have 2 crypto companies producing $1 billion a year in net income, which ranks them, in Binance on a net income basis, would make them the 3rd and 4th most profitable companies globally in financial institutions. Okay. Now, the last thing I want to talk about is FANG and understanding FANG. This is a time series showing you the number of internet users from 1992 to 2017, okay? And the year that each of these FANG companies was started. So Amazon was started when there were 7 million internet users. Facebook was the last when there were 580 million users. Here's an interesting fact. If you didn't understand the business model of FANG, but you just bought them based on the belief that internet users would grow, that explains 75% of the return of FANG. From 1997 to now, FANG was a 1,500 times return. $1,000 invested in 1997 is worth $1.6 million today. And all you had to do is say, oh, hey, there's this many internet users, I think it'll go to 4 billion. You would have gotten this 75% right. So in other words, it didn't matter that Facebook was about social media and Google was about advertising. You just simply bought it based on what I call the secular trend. By the way, how long did it take to figure out if FANG was a winner versus the Internet 1.0? Takes less than 6 years. There's not a single FANG company that was started more than 6 years after the company that it defeated. Just to give you an idea, Facebook beat MySpace within 4 years. But before FANG, there was consumer stocks in the 80s, okay? Now just take a look at this chart. See, if you just said, hey, there's something happening in the 80s called malls, and I just bought 7 names like Home Depot, Circuit City, Walmart, Limited, Gap, Dillard's, you had 1,200x. $1,000 in 1980 turned into 1.2 million by 1995. So before FANG, there was consumer FANG. And of course, now we have crypto. And I think the key here is Bitcoin has been around for 9 years. It has been undefeated. So I think Bitcoin is clearly a long-term winner. And I think the real debate today is going to be around Ethereum.